My name is Brian Polmeyer. I'm Vice Chairman of the Board for Centennial Bank of Lubbock, Texas. Today we're about $720 million in assets, and we're spread across a good distance from the panhandle of Texas into the Texas Hill Country, having around 14 locations today. We have utilized the Federal Home Loan Bank as our access to the capital markets, and it's one of the few ways that a bank has to access that. The ease of utilizing the Federal Home Loan Bank capital market type products is so much easier than trying to go into repurchases. Centennial Bank uses the FHLB of Dallas as a liquidity factor for a couple of ways, but our primary use is funding seasonality of our ag-based credits. Different than some banks, we try not to maintain a whole lot of what we deem to be on-board liquidity of Fed funds sold. We tend to borrow our liquidity on a day-to-day basis as needed. We utilize what would normally be 10% liquidity, or some $70 million that a lot of banks would keep at our size, and we buy 3 to 4 year mortgage-backed security products, borrow the needed liquidity in just-in-time funding, and harvest about 225 basis points on those funds. So in a bank our size, that's worth about $1.5 million a year in additional earnings that we're able to extract from the access to capital markets with FHLB. Just being able to have that access for liquidity allows us to take the investments we're purchasing at way above what we're paying on overnight rates, and then not need liquidity until such time as we have a place to put it. And that is adding significant earnings back to us. We're able to maintain north of a 4% net interest margin, with a big chunk of that being what we're able to do through the investment piece and utilization more timely of liquidity than leaving it sitting in Fed funds all year long. We would then have to go back to the repurchase markets to do the similar thing. The spreads are not quite as good as what we're able to obtain through the FHLB, but also it's not near as easy. We just do a daily settlement. Every afternoon we settle up a cash letter and borrow from FHLB, transfer to the Fed. If we were not able to go in and access the overnight money on a very readily accessible basis that we have, we would not be able to rely on those funds. We would have to go and access in the capital markets. Those are fixed in 30-day type advances, so I don't have the ability to go up and down on a daily basis as we have with the FHLB. And that access that is afforded to community banks by FHLB with that type of a borrowing arrangement is an invaluable service. When we have a customer that wants a fixed term out over, say, a 15-year period of time, we may not want to take that interest rate risk. If we have a 15-year fixed rate product that we are funding, we fund 50% of that, and at a half of the term, say 7 or 8 year takedown, because it's rare that those loans go all the way to 15 years. Customers are changing out facilities, they're wanting to increase, they're wanting to expand, where we're having to do something with those credits. So we found that shortening that term, which increases our spread and accept maybe a little more risk on the interest rate, is worked out every time we've done it. One of the strategies that came out of a meeting several years ago was looking at what you have coming available over the course of the next 12 to 18 months in liquidity. And for our bank, we normally have somewhere on a rolling 12 months about $25 million of cash flows coming off the investment portfolio. So instead of actually waiting until we've gotten those in our pocket, we look at going ahead and reinvesting those out into normally 36 to 48 month investments. mortgage-backed securities, straight pass-throughs, don't really move into the CMO structure, and then are able to borrow those funds immediately from FHLB. For us, that's usually the 25 million range, and then we have a natural cash flow rolling off of the portfolio that will retire those. It's a very good strategy for a bank to employ. Instead of waiting until the minute they have that, is look at what you have, push it out, harvest a 2.25% return, and add that to the bottom line versus waiting around for that cash flow that we know is going to be there. For us, that's running 2% is running 400 plus thousand per year, just in that little strategy. And it takes all of these ideas to be able to make and keep the bank as profitable as we want it to be.